Okay, thank you very much, Andrew, and good morning to everybody here. We know that we are the panel between you and lunch, and so we're going to make this hopefully quite an interesting discussion, hopefully lively, and then we will aim to release you on time. So I'd like to start for a few minutes just talking about the nature of our topic, and we're going to introduce our panelists in the context of that because I think that's going to give the best perspective. So we have at this conference over the last several days been talking about critical minerals, including copper, and the need for abundant and resilient supply to support the massive requirements of the electrification revolution. So we've talked a lot about supply. This panel is going to talk about how much that's going to cost, where it's going to come from, and who's going to provide it. And there's a number of challenges to that. The first is just massive scale. The second is declining grade operational type challenges. And then we have difficult jurisdictions. We have geopolitics and trade wars. We need to comply with ESG requirements, all magnifying the difficulty and importance of this task that is before us. And I think what we're going to find is that from the financing perspective, and remember, to actually get the copper that we need, we not only need copious amounts of reserves and resources, but we need copious amounts of money to get that out of the ground and get it processed. And I think we're going to find that we're going to need somewhere between at least an evolution and probably a revolution in how we finance all of this, which is a great time to quickly introduce our panel, and you'll see how it's being constructed to address many of the angles here. On my far left, we have Paul Gait, head of strategy of Anglo American, obviously a major global copper producer. Beside him, we have Patrick Barnes from WoodMac. Not only is WoodMac a great source of demand and supply information, but Patrick spends a lot of his time advising governments about these very questions. We then have James Hartop, managing director at Centreview, who provides advice regularly on the financing and strategic aspects of this. And James has been heavily involved with me on a certain copper transaction. And finally, Rick Rule, who I think everyone knows. And Rick is going to give us the investor perspective on this, particularly on equity. And do you believe the story of who's going to finance all of this? So that's what we're going to try and do in the next 30 minutes. I'm going to start with you, Patrick. And can you lay out the context for us in terms of what we think the scale of the demand is going to be? How much copper do we need? How much is that going to cost? And in particular, it's not only increasing supply each year, but just to keep up even, we have to replace depletion before we can even increase supply. How are we going to do all that?
Sure. Thanks, Mike. It is a pretty big challenge that we're facing. If you think about the copper industry, in 2025, 2026, the world consumes about 28 million tons of copper. And of that, about 23 million comes from mines, right? The other 5 million comes from recycled supply, roughly. Now, copper demand is set to grow by a little over 2% a year going forward, which doesn't sound like a particularly large number when you consider that it's on a very large base. That's actually a lot of additional tons that are needed. And as you mentioned, all the existing mines that have already been financed are depleting, right? The natural order of mines is that they produce less over time without investment in expansion or extension. Just the depletion alone over the next 10 years, you got to replace somewhere between 2.5 and 3 million tons of supply, right? And then on top of that, there's to meet demand, you have to actually, there's a supply gap of about 5.8 million tons of new supply that has to come online by 2035, right? And that's, most of those mines need to start being built in the next 6 to 7 years if they're going to be producing by 2035, right? Now, it's really hard for most of us to think about what nearly 6 million tons looks like. Chile, as a country, produces something like 5.5 million tons a year. The entire African continent produces something like 5, right? So you're talking about bringing on more than another Chile or more than another Africa operational in the next 10 years, right? Not a small task, right? So I'll pause there. There's reasons why the growth is what it is, energy transition, a lot of it's actually just, urbanization and good old-fashioned industrial production. Data centers produce a bit of demand as well. There's all the kind of things that you're hearing about it, but it's really the supply shortfall that's the key issue in copper at the moment.
So thanks, Patrick. I want to ask you, Paul. At Anglo American, you are obviously focused on copper. You're going to be more focused on copper shortly. How do you react to this in terms of your role as head of strategy, looking at copper, looking at the demand that Patrick has described, and how are we going to finance a new Chile, let alone a new Africa?
Yeah, I mean, it's obviously just a $64,000 question, right? I mean, and if we look, of course, at the sort of supply-demand deficit, I mean, of course, there's, we can sort of project demand, and whether or not one looks at sort of 2, 2.5, 3, 1.5, whatever the number is, off of the base that we've got, it's significant. And as you say, you add depletion on that, and of course, what we get then is this trend trajectory of demand that goes up. We know existing mines deplete, and we get the crocodile jaws of a deficit opening up. Of course, the issue is that if you look at any point in history for any commodity, you'll see exactly the same pattern, right? It's always the case that known sources of supply deplete, right? And it's always the case that demand for the material grows at circa GDP, right? Now, of course, that's not an accidental relationship, right? It's actually the limiting factor on GDP. So it's not that GDP is driving copper demand or metal demand or industrial demand. Rather, it's the industry itself can't supply raw materials at any faster than 2 or 3% per annum, and ergo, it's impossible for the stock of embedded goods to grow any faster than that, and therefore GDP is that. Right, so the order of causation here has to be sort of understood, I think. But then the sort of point is, what is actually then the price dynamic that closes that gap? Because we know that there's no such thing as a negative ton of copper. So sitting here and going that there's a 5 million ton, an X million ton, whatever it might be, deficit for this good, isn't, of course, really the question. The question is that the gap will be zero at n years hence. The question is, what is the dynamic by which this closes? And of course, most of the effects that close that gap are essentially price related. But they're not all price related, right? They're also related to the operating cost structure, the capital cost structure, the permitting environment, the cost of capital, and so on and so forth. So if you sort of break that down and sort of think about the components in that, of course, what you've got is sort of primary supply. But then we need to break that down from sort of essentially, existing mines' operating cost structures and how those behave in the face of different price environments. Because, for an existing mill, sitting, for example, on a porphyry, you're always going to find something to put through the mill, right? So if the grade declines, if the price rises from, 10,000 to 11 to 12,000 tons, what that means to say is you can put, instead of putting 0.3, you can put 0.2% material through the mill, and you'll always be able to do that. You've then got the brownfield expansions of those, so essentially capital that would be needed to increase this, whether or not that's another milling circuit or whatever else it might be. And then, of course, you've got greenfield supply. So all of those on the primary side have a different price elasticity, and you need to sort of think through that. Then, of course, you've got secondary supply, as Patrick was alluding to, both in the refined and also in the secondary, in the sort of semis leg, so the direct and the indirect use of scrap. And, of course, that is also price sensitive, right? Because what you're essentially talking about with recycling, or the price effect there, is accelerating the depreciation rate of the embedded stock of goods, and those stock of goods all have a current economic application. And then essentially the third leg of that is then on the demand side, where you're looking at the price elasticity of both thrifting, so sort of using less, and also substitution, so essentially using alloy or plastics or whatever else it is. So once you've got those price elasticities, you can then sort of get a fairly good handle on how it is that that demand gap is going to close. Of course, then you have to bring in all those other factors that we sort of touched on, the cost, the capital structure, and so on and so forth, to sort of, square the circle, as it were. Not that one can, of course, square a circle, but at least by analogy. So that's sort of the set of things that we sort of try and sort of occupy ourselves with, both in terms of the sort of macroeconomic drivers of this, but then also the broader sort of social, political, and other sort of structural imposts on the supply of those goods. So, having tried to think ourselves through all of that, we get very bullish, ergo we make the bets we do.
So thanks, Paul. I liked your analogy of the crocodile jaws. I think we have a crocodile jaws of need for copper, and we have a crocodile jaws of need for capital to finance that copper. And I'm going to turn to James now. James, I'd like you to cover how are we funding these projects today? With our debt, our traditional debt and equity, maybe some alternative finance in there as well, some project finance. What's going to need to evolve? And in fact, what is going to need to be the revolution to create this financing, literally just the scale? We're in a new Africa, a new Chile. The current mines have taken decades to come to this stage. How are we going to replicate that? Presume we got to do something different.
Yeah, I mean, you're right, Mike. It's clear we've got a big problem to address, and I think and some of the other dynamics that I'm sure those to my left would go on to say is not only is there a big gap to address, but that the timescale of these projects is getting longer and longer. And what that tends to mean is, this funding risk, if you like, it overall needs to be sort of equity funded. Now, that isn't necessarily directly equity funded. The specifics of the financing, I think, will continue to have sort of debt and project financing elements. But either it'll need a significant amount of equity, or it needs the forbearance of shareholders in order to support capital being allocated into the ground for the longer term. Now, unfortunately, what that gives us is an even more acute problem, because what you've got is a set of shareholders that are subject to their own pressures, and they are forced to perform month to month, quarter to quarter, and yet the capital cycle that you've got on the company side is getting longer and longer. So you've got a sort of a supply of capital or support that's needed with really short-term horizons. And then you've got a corporate financing demand with a really long capital cycle. So the question is, and you've got these enormous amounts of capital. I mean, Paul says it's a $64,000 question. I mean, it's a $64 billion plus question in terms of how we deal with that. And I think the solution, there isn't one solution, but I think everyone's got to play a role in that. So what we can't have, and everyone's instincts is, the debate that we're having is a debate, as we know, that it's happening right across the industry. I think there is increasingly this recognition of the fundamental importance of copper in particular, sort of going forward. And I think people are hoping that solves the problem, that there's a recognition of the need, so equity investors will simply be more supportive, that'll unlock I just don't think it's as simple as that. So I think it starts with there needs to be some discipline from the producers. We can't have the problems of old, of everyone recognizes the need for more and everyone just flicks the switch and goes and plows capital into the ground. So I think it's the obligation of every producer to make the case for each project that is something that works, that the risks have been thought through, that the economics stack up. I think hopefully as it lands, across the industry and broader, that these dynamics are going to play through. That'll help with providing the support, so that hopefully the recognition will happen over time, not right at the end. I also think that, I think when companies come to value this, you tend to look at it on your Excel spreadsheet, and that tells you the more that I can invest, the faster that I can go, the bigger the NPV uplift looks like on the spreadsheet, and I want 100% of that. I just think that funding model also needs to find different ways of getting done. So thinking about more sort of syndication, ways of sharing out that risk, in which case it all becomes more manageable. So if this is going to work, everyone's got to come together. There needs to be understanding from the shareholder perspective that returns are going to happen over time. There may need to be a change in the mix of capital allocation, maybe less on the short term, more through to growth. There needs to be real discipline around the sort of the project development, and maybe there needs to be thought around the different models of syndicating risk.
Well, thanks, James. You talked about the key aspect of equity. You talked about different operators competing for that equity with their vision, and you talked about greater syndication. But when we talk to Rick, who is an allocator, an advisor on equity capital, Rick, first of all, I want to be provocative. Do you buy what James has just told us? How do you feel about that?
I absolutely do. And I guess I have to differentiate between, this is going to sound crass, but the needs of society and the needs of a check writer, which are often at odds. While I'm part of society, I'm, as you know, primarily a check writer. What we have in front of us as a society is a problem, and what we have in front of us as a check writer is an opportunity. I'm mostly attracted to that. I think it's important to say in the 5-year term, maybe even the 10-year term, we have what's mostly an unsolvable problem. We're, I think, 30 years late coming to the party. We're 30 years late coming to the party in exploration. We have a lot of deposits in the world that are drilled off, but at today's cost of capital, with today's copper prices, they don't make any sense. Which is a challenge. The deposits that are economic are very, very, very large, and they're beyond the reach of mortals like me. I can do my own small piece. But really, they go to Anglo Tech. Look at the challenges. I was just at Freeport, by the way, so this isn't actually Rick speaking. This is Rick translating what Freeport told me. You have these very large deposits that are $7 billion bills today, except they're not. We think they're $7 billion bills because 3 years ago they were $7 bills. They're $9 billion bills. And the inflation in construction costs is such that next year they'll be $10 billion bills, and then $12 billion bills. Meanwhile, assuming that you wanted to build it tomorrow, if you're in the United States as an example, trying to build Resolution, from completion to feasibility to a shovel, is 28 years. Then, as a check writer, you look at all this, and you look at the increased social rents. I won't do the political risk lecture for this audience, but the truth is that in periods of rising commodity prices, societies represented by governments want, quote, their share without doing much by way of investment. So it's an interesting challenge. The check writer like me comes to understand that if you have 150 deposits, which theoretically constitute supply, except they're uneconomic, and if you look at an industry that's underfunded exploration for 30 years, this is a tremendous opportunity. But you have to be extremely selective in base metals in particular. Price volatility, capital intensity, cyclicality. You have to be part of discovering a deposit that wins what Anglo would call the last man standing contest. You need to be in the best cost quartile worldwide and the highest return on capital employed quartile in the worldwide. So it isn't enough to be technically right, you have to be economically right. And that's going to be a real challenge. I feel lucky in that there are still not many people as willing as I to accept the failure of front-end exploration. It's a fairly lonely place to be, which is wonderful for me, frankly. I have the tolerance for that. My own portfolio is beginning to look like a barbell. There are very few companies in the world that have the technological capabilities and the financial heft to build a new mine today, that have the talent, that have the duration, but frankly, that just have the muscle, the might to build an $8 billion deposit. So on the one hand, my portfolio has a few of those, because that really truly is a durable competitive advantage. just heft is a durable competitive advantage. On the other hand, I don't have much in the middle. On the other hand, the opportunity for a guy like me who is willing to tolerate absolute 100% failure in front-end exploration, I've always liked as a contrarian to be where the enemy wasn't. The enemy being every other check writer on the planet. And so my portfolio is very odd. It's on the biggest and the best over here, and the rankest and the rawest over here. I hope that answers the question.
That's a very, very good start. I want to talk about geography for a moment. I was looking at a mining journal report a couple weeks ago. They laid out the top 20 copper projects in the world. And of the top 20, 15 of them were, 75% were in South America and North America alone. Now, there were exceptions. There's Grasberg, there's Oyu Tolgoi, there's going to be Reko Diq, and a number of those. But when you look at that geographic concentration, and we see it even in the Anglo Tech deal, that's where the copper is. How's that going, I guess ask Patrick, how is that going to affect where this new supply is coming through? Are we still going to continue to see Latin America? Is it going to branch out? And what's the financing difference between those two opportunity sets?
Yeah, so we talked about this number of, call it roughly 6 million tons needs to come online. Just in North and South America, in our database, there's more than 8 million, maybe possibly pushing 10 million tons in the portfolio. Now, as Rick said, a lot of those are ways from economic, right? And Africa looks smaller, but Africa also usually tends to look smaller in the database because deposits kind of appear out of nowhere and get developed, partly because there's a little less transparency in the reporting of when China's been dominant in that space, right? So it's a little bit hard to predict exactly how it will play out, but the data would say that a lot of more supply has to come from the Americas than it has in the last few years. But if you look at what's happened in the last 7 years, since 2019, I guess it's only 6 years, something like 70 billion spent in new copper mines. Over half of that was Chinese capital. Almost 20% of it was Russian and Caspian capital. That leaves the whole rest of the world financed about 30% of the mines, right? So it's going to be a question of is the world going to continue to invite China into the Americas, or are they not, right? If not, then they've got to figure out a way to fund it, or it's going to get built somewhere else. The gap will close, the jaws will close somehow. But it is, it's a difficult problem to solve because you can either mess with the risk side of the equation or the reward side of the equation. The reward is a tough one because you don't control the global market, and it's kind of it's a zero-sum game between investor and government, and as you mentioned, they're all very sensitive to that, right, at the moment, and pushing on that. So trying to move to positive territory, it's got to be, the solution has got to be more on the risk side, meaning time to develop. It's got to be on finding ways to de-risk, collaborate, put in place different, more extensive public-private partnerships. If the West wants to increase its supply, it's going to have to do something because I mentioned the Chinese money that's flown in. They've increased their share of global mine supply from 10% 15 years ago to 20% now. That's a huge gain of share in just 15 years. Huge share. And we talk mostly about Chinese dominance at the processing stage, but in copper, they're making massive inroads at the mining stage as well.
And James, when you're advising your clients, how much does jurisdiction matter, and how does the financing challenge change if you are looking at a major project in Africa or Asia compared to Latin America?
I mean, good question. I mean, jurisdiction, of course, does matter. I mean, one of the things I get frustrated about is sometimes there are these, enormously oversimplistic terms that get implied, emerging versus developed, high risk versus low risk. And that is genuinely an oversimplification. And I think it's very important to understand the specific risks around any particular project, because that's what you need to focus on. Now, and of course, that is absolutely relevant to the investment decision and the financing, because these projects are going to happen over an extended period of time, and you need to be confident that you've got the political, the risk, and the fiscal stability over that period in order to get there. As Rick rightly said, in some senses, this isn't a problem that we don't know where the copper is. This is a problem that the right framework, the right conditions to extract it aren't there. Now, the most obvious one of those is the pricing environment, and on that, the copper price popping up to $6 isn't in and of itself going to solve it, because you need to think about this over a sort of 10 or 15 years horizon. Interestingly, when you look at the world's top, whatever sort of 20 undeveloped copper projects, the biggest single problem isn't actually the copper price. It's social license. That tends to be it's not having the license and the community support in order to be able to get there. So for sure there is a financing issue. It is linked to sort of jurisdiction, but I think this also goes around how can conditions be changed in order to facilitate the development. I think simply standing back and hoping, well, everyone should recognize the urgency of this and therefore we should get the licenses, isn't going to work, because if you're living right next to prospective copper development, you couldn't really care less about that, and you're going to keep the pressure on not to develop. So I think one of the other factors that we need to bring into the financing equation is also how do you build that confidence in the social license to get that support to develop. So not quite the answer you were expecting, but I think it's so important.
Oh, good. That's very, very helpful, James. I want to talk about accelerated value creation and in the copper space, and how that impacts project development and financing attractiveness. I'm going to ask Paul first and then go to Rick. And what I'm thinking about, some of the interesting type transactions that we see out there are the creation of district level scale. That, for example, when Lundin and BHP came together with Filo and Jose Maria, the opportunity where we have QB2 and Kalawasi, those types of things. We're talking about very, very capital intensive projects, and where you can put two things together, where you can create a whole district of development and processing, sharing infrastructure, seems to be a really attractive thing to do. How do you guys feel about that at Anglo, Paul?
Well, look, fundamentally we feel very favorably inclined to it, right? Because the capital intensity is lower, the controllable factors are sort of greater, and with some of the comments that James, sort of made around the fact that, when you've got an existing mine, you already have a sort of sense in terms of the social license, right, around the operation. You are employing people, people can see what it is that the activities are doing, contributing both to the economy sort of broadly, but also the fact that, you are able to sort of demonstrate that what we say we're going to do is actually what we're going to do, right? Whereas that sort of trust, on a greenfield project is something that kind of, you have to build up over time. So in these adjacencies, you've not only got the sort of pure economics, but also those other factors that are sort of working in your favor that will sort of help you develop it. And so in sort of Anglo, we've actually got sort of three of those, right? I mean, not just in the copper space, which is, of course, very germane. We've obviously got what we're doing with sort of Andina and sort of Los Bronces, what we hope we're going to be able to do with Collahuasi and Quebrada Blanca, but also we've also got on the iron ore side of things, the Minas Rio project and Serpentina right next door to it, which is again a very sort of similar adjacency insofar as Vale held the mineral resources, we had the process and the infrastructure, and again we can put those two together in a sort of capital efficient sort of manner. So those for a sort of local condition are really, really important. But of course, the issue is that's the number and the set where there are genuinely synergistic adjacencies in that manner is somewhat limited. I mean, it's the sort of standard sort of thing where you see in these kind of presentations a map of Australia and you get 2 dots and it looks very close, and you think, well, there must be something there. And then, of course, in reality, they're 500 kilometers apart, right? It's just that set of opportunities isn't terribly great. So is this of local benefit? Is this something that we would all sort of seek, right? Absolutely. Is it going to close the gap to the sort of supply-demand deficit? No, because there just aren't enough of them. And just sort of touching on a couple sort of points that sort of Rick was also making on the the issue around the sort of capital cost escalation. The basic problem here that we've got, right, is that the change in capital intensity is rising faster, right, than the price of copper itself, or a decline in the cost of capital. And for this to sort of work, you need those 2 things essentially to reverse. Either the cost of capital has to be falling in percentage terms faster, the copper price has to be rising, or the capital intensity of these mines needs to be falling. Now, in the last wave of really sort of explosive growth in the copper industry, that's of course what was happening, right? The capital intensity of these mines was declining because there was technological innovation that was sort of coming to the fore that was allowing that to happen. So something that we haven't discussed yet is the role that could play, right, in developing that sort of, that sort of supply base. Where is the new technology? Where is the innovation sort of coming from that can act as a sort of deflationary sort of driver, to help sort of, help deliver that. So, sort of short answer to your question is great for us. Is it a solution for everybody else? No. So, ergo, us.
Let me ask from the perspective of the check writer.
Right.
And I think there's 2 aspects on the check writer. There's a pull and there's a push. The pull is where you see these opportunities. Hey, that's a great thing to invest in, and that's great. But I think there's also a push that people looking at projects, the capital is pushing them to create more of those opportunities, whether it's technological, whether it's adjacency, whether it's process, whether it's an ESG benefit. So that all sounds right to me, but how do you see it as the check writer? What are the things that you're looking for on the pull side to respond to a call from capital from a company? And what are the things that you like to push on to get companies to get your check?
It used to, that question used to concern me more when I managed other people's money. I only have one client now, Rick Rule. He's a real jerk. But I have to take I have to take many less things into consideration now. So I'm personally not pushed in particular towards anything. I'm pulled towards high risk-adjusted internal rates of return. I understand your question perfectly from an institutional check writer's point of view. I used to be one of those guys. I'm delighted not to be one anymore. I'm delighted to be free from the circumstance where my efforts are directed to somebody's quarterly cash bonus and more directed towards risk-adjusted internal rates of return with a 5 or 10 year time frame. So for me, I have the luxury of being much more opportunistic than most of the capital in the market. It's odd at age 72 that I've become demonstrably more patient, given how little time I have left on Earth. And I know this is an elliptical way of answering your question, but people who respond to the pushes are pushed to tactics, short-term tactics, that almost guarantee that they don't meet their long-term strategies. And I would say that the greatest improvement in my life in the last 5 years has been able to resolve that dispute myself. I have the luxury, as an example, of doing things that are extremely unpopular. The industry seems to want to go to political risks that look like them. Old, fat, bald white people. So they're intending to go to places like Canada and the United States, acting as though they're politically less risky. I'm not sure they are, by the way. But when I look at the exploration opportunities in the world, people say to me, well, like, if you discover something in some country that I can't pronounce, they might steal it, right? So they would prefer to have a deposit in the United States that isn't worth stealing. You follow where I'm going? On the exploration side of my business, if I'm pushed or pulled towards anything, it is the probability of making a tier 1 deposit, discovering a tier 1 deposit. That means I am, by my nature, either pushed or pulled, depending on your point of view, to, as an example, the Tethyan metallogenic belt, to some part of the world that hasn't been as completely drilled as the United States has. I look at the success that Robert had, really with a pretty simple cover, pretty simple idea, looking under, if you will, the Zambian or Katanga copper belt, where it went under the cover of the Kalahari Sands. Pretty simple idea, except it was in Congo, so nobody had done it. That's what I'm attracted to. That's what I'm attracted to. I'm either attracted to outfits like Anglo that have the ability to be more efficient simply because they blow a quarter of their corporate overhead by merging. I mean, that's an immediate efficiency, unless you happen to be one of the ones who were reduced. And also have the competence to do something that somebody else can't do. In other words, something that I can trust to employ $8 billion worth of capital. Or I'm attracted to the front end where the probability is that every individual effort fails, but where the payoff for a successful effort is so large that it amortizes a bunch of failure. In other words, places like Central Africa or the Tethyan. And mercifully, because I don't have to answer to anybody anymore, I don't have to take into account their preferences at all, which is lovely.
Well, that's very liberating, Rick.
It is.
Very liberating. I want to ask one last question, and I want to be a little bit provocative in terms of what's being covered in this conference over the last 3 days. A lot of talk about government funding, and that the government in various jurisdictions is funding critical minerals and production and processing. When we're talking about, and this is, I want 30 seconds from Patrick and 30 seconds from James to crown this off, but does government funding for these projects actually matter? Does it make a difference? This is kind of your verdict on the last 3 days in 30 seconds each. Patrick.
Yeah, I would say equity funding from governments is a relatively blunt instrument. Depending on the commodity, it makes more sense for some than for others. It does have a strong signaling impact, right? And it brings in other parties sometimes. But I think what's really needed is more patient capital, more investment in the more Asian historic model, people that are thinking over 5 and 10 year timeframes. Sovereign wealth funds, governments have the potential to do that if they'll get organized. So I think it has the potential to. I'm not sure that everything we've seen is kind of reaching the efficient frontier of how to do it, but it's a good step in the right direction, I think.
James.
I'd say it's part of the answer, but it's probably a relatively small part of the answer. I mean, as Patrick said, part of it is a really important signaling indicator, but I think it's got to set up the conditions for success, which is more broadly working together, making sure that there is the social license and the broader community support, voter support, in order for this to be something that's sustainable.
Fantastic. That brings our panel to a conclusion. Thank you very much.
Thank you very much. Give a warm round of applause to the panel, and especially to Mike Am, who I know has spent a lot of time curating what has been an absolutely